webinar organized by Standard Chartered Bank. At the onset, on behalf of the bank, I would like to thank you all for joining in this webinar, and we look forward for your active participation. Today's webinar, we look into the world of investments and how to plan your investment journey. Through this webinar, we aim to help you understand the benefits and risks of investments, from defining asset classes, the various products, your risk appetite, which will help you assist in your investment journey and meeting your financial goals. We aim to cover it all. I would like to request you all to please keep the questions coming forward. And who better than Mr. Gaurab Parija, who joins us for this webinar. Gaurab Parija is the head of sales and marketing at IDFC Asset Management Company Limited. Mr. Parija has an experience spanning over 22 years in retail sales and distribution. He has been associated with IDFC AMC since March 2017. Prior to joining IDFC AMC, he was associated with Franklin Templeton Services Private Limited as Director responsible for new initiatives and business development, CEMEA India. Prior to that, he was associated with Franklin Templeton Asset Management in various leadership roles, from National Sales Director, Head Retail Advisory Services, and Head Alternate Distribution. Thank you, Gaurav, and for joining us, and over to you for your opening remarks.
Thanks, Vinay. Thanks for having me here. It's great to be part of this forum. So my discussion initially would be around how do you plan your investment journey. And I thought that most of you who are on this call are typically starting out with your careers and investment journey. So I thought I'll flash back to how I started my investment journey and planned it over the last 20-25 years. So very early post my graduation, I happened to chance upon a very interesting book, and I would urge most of you on this call to pick a copy of it. It's a book called Rich Dad Poor Dad by Robert Kiyosaki. Very simply, it outlines the reason why 20% of the people control 80% of the wealth of the world. And it defines investment habits and expense habits. And that was the starting foundation on which I built my investment journey. Now, many a time you would have heard your relationship managers, investment counselors talk about a term called asset allocation. At the cost of sounding boring and repetitive, there is actually a study done in the US which states that the three primary reasons for wealth creation, the first important reason is asset allocation. The second is your ability to handle what is called emotional and financial stress. And third boils down to choice of the right fund house. Only 5% of wealth creation, as per the study, is attributed to your ability to time the markets. And so very early in my life, I realized that the key to creating wealth for me in the long run is all about getting my asset allocation right. Having said that, many a time when we talk to clients, and for me, most of my clients are my relatives, I realize that when they talk of asset allocation, it pertains to asset allocation of that single investment, and which is, I think, a bigger mistake. When I mean asset allocation, I talk about asset allocation across all the assets you own. So literally you have to go back and go to your house and scurry around and find out how much of insurance you have, how much of fixed deposits you have, how much of property you own, and that's your entire net worth. And within that, you start figuring out how much you have across equity, fixed income, gold, and other asset classes. I think that's the first starting point. The second thing I did, and I realized very early in life, is that as you get into your professional lives, irrespective of whether you're working for an asset management company or not, one really doesn't have time on a day-to-day basis to look at investments and portfolios. So I realized very quickly the need to have an advisor, and Standard Chartered Bank is also one of my advisors, and just let the advisor decide what is good for you. Obviously, given that you come from an AMC, you have a little better knowledge and feel of what are the products which is suited for you. The third thing I've always maintained is investments is very boring, and many a time we tend to get over tactical and try to be exciting in the investment journey. I've realized that if you are lazy and stick to your asset allocation and not react to market news, and I think the amount of news you get, be it through social streaming, media content has exploded over the last 10-25 years, your ability to create wealth magnifies to that extent. So many a time when market clippings come that market has moved 500 points, I find a lot of my clients or even relatives calling saying, oh, market has moved 10%, 5%, what do I do? And that's where I think your ability to handle these market movements will come in critical in creating wealth. This next step in all this process is how often do you review your portfolio? I think while it again sounds boring, I have maintained a discipline that at least once in 6 months, I go back and review my portfolio along with my advisor and do necessary portfolio rebalancing and shifts if required, depending on how my asset classes have moved. The other big success in my wealth creation has been while I have real estate assets, I have relied very lowly on the leverage or the debt I take to create these assets. The focus has been to create as much assets without taking any significant amount of debt and leverage. And that's what has helped me over the long run. So just to sum up, I think if I were to put my basic learnings of my asset allocation, my investment journey, it is all about getting your asset allocation right. It's all about keeping it simple. It's all about keeping it boring. And then leave the markets to do the necessary growth in your portfolio.
Thank you, Gaurav. Thank you for sharing your insight on your investment journey. I think it's a good starting point for our clients also, and also as the questions filter in, maybe few questions we can kickstart off
Sure.
With our discussion is one is this whole concept of SIP which has come into the book. So how would you explain the basics of SIP? What should you do in SIP? Is it you should do SIP only for equity, or even debt also you can do SIP? All that, the whole gamut on SIP.
So SIP, I'm fairly certain that most of you on this call would know stands for Systematic Investment Plan. Now there are multiple debates on whether investing through a SIP or investing lump sum is better. The only way I look at investing in SIP as to why it is better, it just creates a very simple discipline in your investment pattern. And for me, that is the biggest advantage of doing an SIP. Clearly, your SIPs need to be aligned along with your financial goals. So if you have a goal of your daughter's education 15 years down the line, you need to create an SIP in an equity fund. But if you have a short-term goal of paying off a housing loan over the next 2 years, a SIP in a fixed income is not a bad idea. I think most Indians typically tend to associate SIP with equity. I am a firm believer that like our parents or grandparents had the whole concept of investing in a recurring deposit, SIP in a fixed income fund also is a great tool to create money for the short term goals. So I think SIP is a fantastic concept. Over the long run, people might think that investing in a lump sum will outperform in terms of returns, but I think SIP brings that significant discipline which is critical to create wealth over the long run.
So from your point, maybe SIP should be more linked to your asset allocation rather than looking at whether I want to do SIP in equity or in fixed income. So you should have a target goal of achieving your asset allocation and use SIP through that route, which is that.
Absolutely.
So we've had few questions, so we can start taking them. First is how to start a mutual fund SIP, which is that.
I think it's a very simple format. You just need to do a KYC with your relationship manager and with the bank. And I think the bank offers a facility where you can start a SIP online. So it's a very, very simple process to get started.
So next question is, everyone says invest for the long run. But is it okay to stick for a portfolio for 5 years in the hope that it will yield good results in this duration? At what stage do you decide to rebalance or exit?
Very interesting question. I think, and this is a question I've got asked many a time, and the other question which keeps coming is how long do I have an SIP for? The answer to this is very simple. Why 5 years? And that's where you will start to analyze as to the answer for this the question. Like I said, your every investment decision has to have a link to a particular financial goal. Once you define your goal, and what's a goal? It's very simply saying I'm starting at point A, I want to go to point B. Now, in this forum, there could be 3 people where the point A and point B would differ, and depending on where your point B is, your asset allocation changes. So while 5 years is a good enough period to determine a particular investment solution is doing well or not, I really don't think I can answer the question whether 5 years is good until you really know what is the risk profile, what is the investment goal of the underlying client.
So but maybe as you pointed out earlier, every 6 months you should be reviewing at least your portfolio so that you know exactly where you are with your asset allocation as well as performance. Are you reaching that goal which is there?
Absolutely. I think the periodic review with your investment advisor is critical. Like I said, asset allocation for every financial goal or need is decided at the beginning of the goal. And if you are drifting away from your asset allocation, that's where the review period comes in handy. And you come back and do what is called a portfolio rebalance or a portfolio shift back so that you maintain your asset allocation. Asset allocation can be three types. It can be goal based, it can be need based, and it can be tenure based. So depending on which particular phase you are, you do your asset allocation and rebalancing.
So this is more of a we have this concept of direct plans in mutual funds. Do you recommend doing direct investing in mutual fund, or how should a person take this up?
See, quite honestly, like I said, I've worked in the mutual fund industry now for the last 23 years. Despite that, I really don't think as a professional I've had enough time to analyze the various funds available, the changes in the underlying schemes, the changing in regulation, classification, and all of that is meant for saving that 100 basis. Should I go and invest on my own? Because I think many a time people forget that return of capital is far more important than return on capital. And I really don't think 75 basis to 100 basis should hurt you in the long run. And that's the amount you actually pay an advisor. So for that amount of pricing power, I think the use of an advisor is far more suggestive and important.
Is there any standard rule as to how much percentage of your income should you put away for SIP or mutual fund investments?
So the thumb rule I have used is typically when I look at SIP investments by clients, either people are under invested or either people are over invested. So if someone seems to have liked SIP, they seem to be putting away so much of their income that they hardly have anything to spend. And at many a time when there is an emergency spend required, they go back and cut back on their SIPs. So I would again go back to the drawing board and figure out if I have rupees 100 of income, how much expenses I really need to have, which is absolutely critical and must do. What is the balance left? And of that balance, invest in SIP to a certain extent, which I know I will be able to sustain, irrespective of anything drastic which comes up in terms of a need. Having said that, if there are emergencies and medical needs, I presume you would have already covered that with alternative products on insurance so that you don't dip into your SIP or stop your SIPs.
But broadly, there's a lot of questions coming. Any thumb rule? How much percentage of your income should you, or your monthly salary, 20%, 30%? For a young a young professional will be around 30 years. What is there a certain thumb rule he can work with?
Honestly, I think I would leave it to the investment advisors. It depends on the cash flow, the risk profile. What is your work you are doing? Are you an entrepreneur, which you may not have visibility of earnings, or are you a salaried? So I think it's a very tough call. I've personally, even at current stages, run 50% of my income in SIPs. So if that's any measure, I think that's the answer to the question.
Actually, you raised quite an important point also on SIPs, that it should first you have SIP is one sort of tool, but we should ensure that we have insurance for medical and other eventualities, plus also keep some amount for emergency funds and all, and then have this as a lock and stock which you can keep away for some time.
Correct.
Some people say the SIP amount should be the amount which you're not worried about that money. It just lies there, and you are not need that money, so you can take it for 6-7 years, which is there.
Yeah, again, I'm not a big fan of the end tenure of 6 years or 4 years or 5 years. I again keep coming back to the starting point which I made. It's all about what are you saving the SIP for. If it's for 15-20 years, you have to ensure that it runs for 15-20 years. Many a time there's an urge also to look at the SIPs and underlying funds and say, oh, these funds are not performing, let me get out, get in, get out. I think all those decisions have to be discussed with your investment advisors or the relationship managers, and necessary changes have to be made. I honestly don't think there is any thumb rule which works. I think obviously the amount of equity you will have a thumb rule. Some people say 70 minus age is the amount of money you should put in equity, 100 minus age, but For SIP, I have not yet, at least in my experience, I have not figured out a thumb rule. I think it's more on the underlying need and asset allocation.
So this question is from a person who's 30 years old. He wants to understand if he has a goal of buying a house. This is a very common question in the next 5 to 10 years. How should he look at and how should he start investing?
So again, it depends on the amount of money you need to buy a house, and to that extent back calculate the amount of money you need to save. Unfortunately, as your goal is only 5 years down the line, you cannot get very aggressive in your allocations to equity, because over the next 3 years at best you can be invested in equity, but post that you have to start cutting down your allocation to equity. If you've not already built up a lump sum, I don't think the full amount for your house can be invested. Again, I'm not very sure of your underlying income and your net worth and all of that. So again, I think I'll be incorrect in giving an assessment of how much you should save. But to whatever possible extent you can save, I would plan an SIP for 3 years out of the 5 in equity, and then start cutting down on equity as my tenure comes closer to the 5 years.
So this is a question. Since you had talked of asset allocation, is there an ideal balance of asset allocation between real estate, debt and equity?
A very interesting question. As a person who's worked in the asset management industry, I would tend to get biased towards equity and fixed income. I've always maintained that, and again it's open for debate, that real estate should be actually used for consumption. So if you plan to stay in the house you are buying, it's a great option. But many a time we find that people have invested in real estate as an investment tool. There are multiple studies which have been done that even in a country like India, where real estate is perceived to have given supernormal returns, you can actually figure out that by investing in plain vanilla mutual funds, the returns are as comparable. The mutual funds are liquid, and hence I think except for your consumption use, I would tend to put most of my assets in liquid assets, which are equity and fixed income. When I mean liquid from the point of your ability to redeem very quickly. Real estate in India clearly comes with a challenge that your liquidity is subject to supply and demand, and it's not a very liquid option. But again, having said that, I'm of the opinion that if real estate for consumption, it's a good asset class to own. Gold, unfortunately for me, I have never been a big fan. Please remember, gold is a asset class which doesn't create value on its own. It is an asset class which does well when the world around goes into a recession or there is gloominess in the world. So it does well when everything else is not perceived to be doing well. So gold, for me, I consider more of a investment ornamental value as against the investment value.
So this question is from actually a student. She's only 19 years of age. And she's asking, how can I start investing?
I think it's great to find that people as young as 19 have logged onto the call and are keen to understand about investments and wealth creation. I think it's a fantastic age to start, provided you have your income flows already in place. Like I said, at this age, while there is a tendency to buy consumables, the latest gadgets and mobiles, I urge you that you should consider buying them. It's not all about investing, enjoy your life, but like I said, you have to figure out what are your investments for. Are you planning investments for taking a holiday 5 years down the line? Is it to fund your education 2 years down the line? Or is it for your retirement? And depending on that, you need to figure out the asset allocation. Again, many a time I will keep coming back to the starting point saying there is no ready-made rule or solution for which can fit all. It all depends on the underlying needs, goals and risk profile. But again, I must compliment the question and the person asking it, that at such an early age, people are actually worried. And the challenges I see in most youth is that you talk to them about retirement. Many of them say it's too far down the line for me to even bother thinking about it. But I think as India moves from a defined benefit to a defined contribution rule, I think the importance of retirement savings is only increasing.
So this is more specific to funds, because diversification is a very key theme and all. So people tend to over diversify. Is there a thumb rule of how many funds you should have in your portfolio? 10, 15, 20, how much should you keep?
So again, let me share my experience. Fortunately, I've spent most of my working career in two mutual funds, so my investments have been restricted to at best three mutual funds. What I've tried to do is build what is called a core portfolio and then something called a tactical portfolio. My core portfolio does not consist of more than three funds in the multi-cap space, and I will not get into the technicalities of what is a multi-cap, large cap. I'll leave it for, I don't know if people are keen to for a later question. At times I use tactical strategies to build say 20% of my portfolio, but all said and done, I have decided that on the equity side I'll not be invested in more than 5 to 6 mutual funds, and on the fixed income side 3 to 4. So basically a basket of 10 mutual funds is all that I have across my entire portfolio. The question people ask is, what do you do when you get a fresh source of income or you get a bonus? And while the answer might be boring or it might sound textbookish, I literally divide the amount into 10 slots and buy the underlying funds. It's as simple as that. And irrespective of pre-elections, post-elections, market at 40, market at 30, the question I also keep getting is, so markets seem to be high. And unfortunately or fortunately, I've now seen 37 highs of the market starting from 3,000 of the index. So if I was to wait for a high, I would have waited for eternity. So I think my very simple message, like I said in the beginning, is stick to your asset allocation, keep it boring, but keep investing.
So this question is from another investor. As a new investor, what should one start with? Investment in a mutual fund, SIP, ELSS, etc. Would appreciate some insight on this.
Yeah, I think it's good to know that many investors in India today consider SIP to be not part of the mutual fund industry. It seems so much like that it's a separate concept. But let me tell you that SIP is an integral part of mutual fund. So I think as a beginner, I would definitely urge you that until you have very good knowledge of investing directly in the stock markets, just go and start a simple SIP in a mutual fund. Again, the choices of which SIP, how much to invest, I would leave the discussion between you and your advisor. To start off with, I would seriously ask you to, again, before an SIP, do a very simple homework of why SIP and what is the need for creating that SIP, and all the answers will automatically then fall through. I think it might sound repetitive, but the starting point is defining what are you investing for.
So this question, maybe I could take it. It's always a challenge when your investment advisor leaves the company and joins another. Is it better to have the same advisor or move one's portfolio when he moves, or keep with the corporate entity? At Standard Chartered Bank, what we endeavor to do is to give, as Gaurav also highlighted, is first seek a client's asset allocation and give him products related to that asset allocation. The advisor obviously has a greater control, as well as the RM has a better relationship, but we try to institutionalize our process, which helps even post the advisor leaving or the RM leaving or even any of us leaving, so that that process continues and helps you in your investment journey. So that's a short answer which I would like to give. Gaurav, if you want to add something to that.
Yeah, I think I'll second that to the fact that you're dealing with the institution, and institutions have built processes around how they manage client portfolios. So irrespective of who is your front-facing relationship manager, investment counselor, I think the processes don't change, and hence their ability to give you right advice is while it's dependent on a person, is not so much dependent that if the person leaves, you will be left in the lurch. So I definitely think that the process would far outscore the individual when you deal with the institution, and that's been my experience. Like I said, I continue to be advised by Standard Chartered on one segment of my portfolio, and every 6 months or 1 year when there's a change, the first question is there a change in the underlying investment process, and the answer is no.
Now we're getting into few questions on markets. So with recent cases of DHFL and other groups problems, can we consider debt mutual funds as safe?
Oh, absolutely. I think while there is a lot of news on what is happening on ILFS, DHFL, SL and all that, the fundamental issue on investing in debt has been that people have not looked at investing in debt across three buckets, and we in IDFC define investing in debt across three broad buckets. The first bucket of investing in fixed income is liquidity bucket. What is the money you need to keep liquid? So those are your cash and ultra short investments. The second bucket, which I think fits most Indians, is the core bucket of investing in fixed income. And most of us in India are risk averse, and hence we've typically either in fixed income tended to be with the postal savings or the bank deposits or the HDFC FDs and all that. Now, and hence what you need to figure out is there a mutual fund which replicates the same credit quality, in that the mutual fund invests in papers which are AAA rated and better. As long as you are with that, I think from a risk perspective, you are far better off than moving on to the issues which faced a lot of the credit crisis. Now, where the mistake has happened is people have, in the need for higher returns or higher yield, moved to what we think is the FD plus bucket, where you want a little bit more return and or alpha as they call it in technical terms, at the cost of diluting two critical aspects of an FD, which is diluting the credit quality of your investment or diluting the tenure or duration of the investments. And that's where people have run into trouble on the debt mutual funds. But as a core investment proposition, debt mutual funds clearly, and if you look at the universe of the amount of money we manage in asset management, out of the 25 lakh odd crores, 15 lakh crores is still in debt mutual funds. And barring these instances which you keep hearing and media has been highlighting, I think 99% of assets are absolutely solid.
Thanks, Gaurab. So what, in today's market condition, what's an average return one should expect?
So I have a thumb rule for that. I think on the equity side, the thumb rule I use is you have to look at what is the GDP of a country. You add the nominal inflation to it. P7 and inflation is say currently 3 or 4. You should get 10. Add 1 per 2% depending on the ability of the fund manager to create alpha. So bottom line is anywhere between 10 to 13%. Now, the moment I say 10 to 13, depending on the market scenario, people are either too happy or too disgruntled. If I say 10 to 13 when the market is extremely bullish and last 1 year returns have been 40%, people dismiss me saying that, oh, this guy doesn't know too much and he's being too pessimistic. But if I say the same 10 to 13 when last year's returns were minus 25% or minus 10%, people say that I'm being too optimistic. So please remember from the markets, there is a saying which Benjamin Graham says, and I think pretty much sums up equity markets in the most profound manner I have ever read. It says stock markets act like a voting machine in the short run and like a weighing machine in the long run. So effectively, the returns you should expect from your investments are the returns the companies will give, and the returns from the companies are very simply linked to the earnings of the underlying company. If the company doesn't have earnings in the long run, rest assured the market will not give the returns on the stock. So long story short, the returns from the equity side, I would be extremely happy if over the next 10-15 years I get 10 to 12% on my investments. Please remember that 10 to 12% is coming on the backdrop of inflation, which is at 3%. So you're looking at real rates of return in excess of 8 to 10%, which is by far the highest across the world. I think most people in the world would be extremely happy if they even get 1% real rates of return. In most developed countries, you're now running into negative territory where you have to actually pay the bank to leave your deposits. On the fixed income side, your returns will be aligned with how the 10-year GSEC is moving. So if the 10-year GSEC is around 7, to expect significantly higher return than 100 basis above that means what I answered in the previous question, you have to take a little bit of more risk, and as you take more risk, the volatility of returns increases, so you could end up either making 3% or making 10. So to be on the safe side, I think if you have to look at an average return on fixed income, I would align myself with whatever the return is around the GSEC plus 50 basis.
It's a very valid point. Would just like to add here, in case of India, actually, in the last few years, your nominal returns of equity would be in the range of 10 to 13%. Especially if you are in the large cap, it would be still 10 to 13. If you're in mid and small, you would have been negative, which is there. But having said that, even debt has given returns of around 8 to 9%. This seems low, but your point on real returns is very valid. In fact, if we went 6-7 years back when we used to get 15-16%, inflation was running around 8-9%. So your real return was actually lower. Right now, with inflation being lower, your real return is much higher. So rather than targeting average returns, maybe what a client should see is what he would like as a real return post inflation, because that's what would be your actual return rather than seeing the nominal part which is there. So there's a question, quite an interesting question. Is there any possible difference in asset allocation between a resident Indian or an NRI? How we should look at?
No, I think asset allocation really doesn't differentiate between the residency of the client. Asset allocation is more linked to the underlying goal. Yeah, what the residency will differentiate is in which funds can you invest. Some funds don't allow you to invest depending on the domicile of where you are residing. But beyond that, I think the asset classes, the various proportion of how much you can invest in equity really doesn't matter on the domicile of or your domicile. So I think asset allocation is agnostic of where you stay.
So this is more from a senior citizen of ours. What should they look at ideal fund? Where should a senior citizen look at investing?
Again, I think it's a very good question, and many a time people tell me that as you retire, the need for equity is not there. I have a differing point on that for two reasons. The first is, once you retire, while you want to maintain your quality of lifestyle, your expenses also are not going to be significantly higher. Now, if you have a kitty which takes care of your expenses significantly well, there is no reason why you shouldn't invest 20 to 30% in equity. That's my first assessment, because please remember, in India during independence the average mortality rate was 36. As we speak, the mortality rate is going to 60, and over the next 20 years, as health sciences improve, I think the average age of an Indian is going to touch 90. Now, if you retire at the age of 60, you pretty much have 1/3 of your retirement age, living age, in retirement. And if you don't invest in an asset class which comfortably beats inflation, we might at some stage run out of money. So I think it's critical to keep investing in equity at all stages of life. The second reason I think why people post retirement need to look at equity is, again, a lot of people who've retired have a large kitty which they want to pass on to the next generation. And clearly for that amount of money, which is for 10, 15, 20 years down, be it for your children or your grandchildren, clearly you need to look at investing in equity. So the way I would manage a post-retiral investment is invest in a fixed income / balance fund to meet my current expenses. The excess money which I have, which I don't need, I would safely put it away in a equity fund.
So this is also an interesting question, and I'm sure most of young clients or people who have houses face this problem. So if you have a housing loan, should you first look at clearing that loan, or allocate some funds and investments and use those funds to clear the loan?
Yeah, it's an interesting question and a tough one to answer. I think it all depends on what is the amount of loan you've taken, what is the rate at which you've taken, and what are the current opportunities you get to invest at the current juncture. So if you've taken a loan which is at 8%, let's say today, quite clearly for the first house you get a tax break, so you have to add that back in terms of your savings. And if you think there is a clear opportunity to get more than 8% outside in a asset class which doesn't take too much risk, I would then use the money to invest in the asset class and then pay. But it's a tricky question. I really don't think, like I said at the beginning, I've fortunately have had no leverage for real estate, so the wrong person to ask this question. But again, it depends on your tenure, whether it's a floating rate, fixed rate, and more importantly, what is the alternative for you to invest. Now, many people think that, oh, you know what, equities will give me 12%, I have a loan running at 8, why should I pay that loan when I can make 12 and use the 4% margin to pay my loan? But it's the biggest mistake investors make is that you try to leverage your investments, and this is what you do. So I would not, while I am not being able to give a complete answer, it again depends on a lot of factors as to your tenure and the rate of loan.
So maybe for when you have a housing loan, if it's already a very big chunk of your outgo, of your monthly outgo, maybe clearing it is better, so that post that you can start your investment journey. And as highlighted earlier also, SIP which you want to do, maybe you see funds or you see particular assets. Once you have finished all your monthly outgo, you should look at housing loan also as a monthly expense, because it will continue for the
Sure.
tenure which is there. So this question is following up on the debt question which we asked. Now there's expectation of similar story playing out in other groups also which is there. So how will that affect debt funds and the scenario?
So I think quite clearly, if there are issues in other companies, there will be an impact to the underlying mutual fund or debt fund which has bought these assets. Most mutual funds are doing a markdown in their net asset values or NAVs. So to that effect, you will get impacted. Having said that, like I said, you need to look at what percentage of your assets are invested in those type of funds which are taking credit risk. And if I were to draw an analogy of investing in a credit risk fund to investing in equity, if in an equity portfolio you have put 90% in a mid and small cap segment, your portfolio is exposed to significantly more volatility than a portfolio which is more multi-cap / large cap oriented. So similarly, in your debt portfolio, if you have more than a certain threshold in funds which have taken underlying credit in their portfolios, credit, please remember, like any other bank, if you invest or lend to a company, every bank has at some stage had some NPAs, and I think it's part of the business, because when you give a loan, you're not sure which company will give the loan back. So similarly, when people invest in take credit risk in funds, I think you have to get used to the fact that once in a year or in a portfolio, one of the companies might not be able to repay, and you will take an impact, which hopefully, if it's limited to a small portion of your portfolio and the other investments giving you higher returns, should compensate for that one-off. And that's how you have to look at it. But extremely difficult to say which company, which portfolio will the next issue come up, because I don't think I would be wanting to comment, and even the portfolio managers would know with precision as to which company will go down. Credit issues can come for three reasons. One, obviously, if there is significant corporate governance issues in a company. Two, credit issue can also come if the company is operating in a sector which sees tremendous pressure. So be it if you're in the steel sector and the steel sector globally does not do well, the underlying company could have issues in paying off the loans. And third, obviously, is if the company is highly leveraged and hence not able to pay on the short term, which is your liquidity issue. So there are multiple risks associated with credit. So like I said, you have to realize that you can't allocate a significant portion to credit if you are anticipating a smoother journey in fixed income funds.
Our take would be here is that in case you are finding it so jittery, that's is a starting point itself, where maybe your asset allocation is not right for you. You might have gone into the credit risk fund for that extra reward, but you've forgotten the risk which is there. The name of the category itself highlights that it's a credit risk fund, and that's why we have to be, if you're not comfortable taking that 150 bips, it's better to be in a stable debt funds or in the lower duration funds which don't take that much risk and invest in more secure papers which are there. So the next question is again, BFSI stocks have performed very well in the last few years, but given the recent default, should BFSI focused funds or funds which focus on BFSI, should we look at investing or should we stop investing?
So my thumb rule on investing in sectoral funds, and again I keep pulling back to my starting point that while I've worked in the asset management industry, I think I'm like you, a fairly naive or laymanish in terms of which funds and which sectors, because I'm not a fund manager. So the way I've approached my investment plan is I really don't like thematic sector funds. I would rather play the diversified funds, because each fund manager then takes a call depending on his outlook on a particular sector to be either overweight or underweight. Now the banking financial services, please remember, is now 40% of the index. So most funds, whether you like it or not, would have a fairly large allocation to the banking financial. So the way I would look at playing the BFSI sector is just buy my diversified multi-cap funds, and they would give me allocations to BFSI. The other thing about sectoral funds is quite clearly given that they invest in a particular sector. Many a time we typically do not allocate more than 5-10% in a sectoral fund. Now the question I always ask clients and advisors or anyone who wants to buy a sectoral, will that 5-10% allocation give you that significant uptick in alpha over the long run and for you to invest in that sector, especially if the client who is investing doesn't know the sector. Now if you are from the pharma industry, for all practical purposes, please go and buy the pharma because you would know the insides of the pharma industry. But for people who are not even for a person who is from the banking and financials, given so many changes, I would just play it in a diversified fund as against buying into a particular sector fund.
So the important point here for sector thematic, keep it very small in your portfolio, around
At
5 to 10%. And in fact, what people don't realize here is when you're taking a sector call, you're taking added risk because it is only in a particular sector, and given the nature of markets as well as regulations and policies, you can have very drastic change which can impact the sector. So playing it through a diversified fund is much better alternate route which is there. This question is what is the future of small cap and mid cap funds?
The future, I think there's a mixed view again on this segment, and it's mixed right between the lines. There is a segment of people who think that the current valuations in the mid and small cap sector are actually far better than the large cap, and unfortunately what we tend to look at is what is the P of the mid and small cap, and many a time we don't realize that unlike the Nifty, there are in the mid and small cap many companies which are actually reporting losses. Now the way P is calculated is it is basically price divided by something called earnings per share. Now if there are multiple companies which are giving out losses, your earning per shares gets deflated and hence your P actually gets inflated. So one of the measures we at IDFC AMC do is look at what is called positive P. So basically, very simply, it strips out the loss-making companies in the mid and small cap and then recalculates the P. And what we find surprisingly is that while 1 year back the valuations of mid and small cap were higher than large caps, currently if you look at positive P, the valuations are significantly lower than large caps. Having said that, let me again pull you back to my starting thesis or the way I built my asset allocation. The core of your portfolio has to be a multi-cap fund. Use mid and small as your tactical options or as your alpha creators. So clearly as an individual, I don't want to be more than 25 to 30% in mid cap. Please remember, when you are in a diversified fund, the diversified fund also has exposure to mid cap. So many a time the mistake people make is that they invest 50% or 60% in diversified and say, oh, I'm only 30-40% in mid cap. Failing to realize that 50% of the mid cap has 40% of mid caps, of the diversified has mid caps, which effectively takes your mid cap exposure well in excess of 50%. Now, if you are very clear that you can manage volatility, which the segment will bring, mid cap and small cap is not bad, but then you have to be able to handle what I call emotional and financial stress, because your portfolio can move up and down very sharply. Long story short, mid and small caps still offer great value. There are great companies in India in the space which can become large caps going forward. But please assess your risk profile. Don't overboard or overdo the mid and small cap exposure.
That's a very good point actually, that whether it's sector funds, whether it's mid cap segment, as you go down the risk curve and you look for reward, you should also keep in mind whether you are able to take that risk which is there. In case in the last 2 years has been very tough for mid and small cap funds, and if you couldn't take that appetite, then it's better you should be in a multi-cap fund rather, or in a large cap fund where you might get lesser return but you might be still more peaceful, because as you stated, investment is a very boring journey. So if you want to make it exciting, then you have to be aware that there could be risks also in the horizon. This is quite an interesting question. For regular income, which is more suitable option, dividend or an SWP system?
Hands down SWP, because with the current taxation, it's the same level of taxation which faces both dividend and SWP. Dividends, while if it's an annual dividend, it's not bad, but many a time what happens is people get into this whole fascination that dividends in a mutual fund is not coming from the NAV. In a mutual fund, unlike a company, the dividend comes from the NAV. So it's a very simple trick that if your starting NAV was 12 and you got 2 rupees of dividend, your NAV falls to 10. Dividends in a company actually come from their profits. So it's a very, very different concept of dividend in a mutual fund to dividend in a corporate, and that's where the confusion happens. Now in India, we get fascinated the moment a check comes into a bank account. We think the fund has returned more. But historically, if you look at it, given that for every dividend there is an expense which the underlying fund has in terms of paying it out, crediting the bank accounts, in the long run, the growth plan actually outperforms a dividend plan, even if you were to take back the dividends and do a reinvestment. So in my opinion, if you're looking at a regular stream of income from an equity fund, do choose the systematic withdrawal plan. After a year, I think the mistake again people make is that they choose the systematic withdrawal plan immediately after they invest, which is from the next month. Please remember that as per current tax laws, you will be taxed at a very significantly high level. So the way to do it is, if you have a need for a regular income, invest an amount and strip out or take out the amount you need for a year and put it in a bank account. As simple as that, and use 12 installments from the bank to meet your current year's expenses. From the 13th month, please opt for SWP.
Thank you, Gaurab. This question is IPO or MF, which is a better option for short term?
Firstly, I don't think you should use any, and I presume when you say MF, it is equity MF. I don't think you should use any of them for the short term, be it an IPO or an equity MF. Secondly, if it comes a choice between IPO and equity MF, if you are part of the industry from which the IPO is coming, by all means go and buy into that IPO. The challenge again comes back, how much would you buy? If you are buying out of 100 rupees of your net worth, you buy 2 rupees, what is the alpha the IPO will give, which will move the needle in terms of your overall wealth creation? And the answer clearly, it's not going to give you significant uptake. Now, if the IPO is a good IPO, rest assured all good portfolio managers would want to go and bid for it. Now, the way the IPO works in India is that there is a pre-bidding and IPO is then open for public, and more often than not, most institutional clients, which are mutual funds, actually get allotments significantly more than what individual investors get. So in my simple experience, if I wanted to participate in IPOs, I would just again leave it to the portfolio manager to take his judgmental call on whether the fund should be investing in the underlying IPO or not. I really have stopped investing in IPOs for last 15-20 years. In fact, I'm not sure if I've ever participated in an IPO.
Actually, that's a very valid point. Also, investors should or clients should be aware that IPO is in the end you're taking a single stock exposure, which could become quite large in your portfolio. So the risk is quite high, which is there. And we've seen historically that IPO returns have been very patchy. So it's better left to a portfolio manager who can stream out and pick the actual IPO which might actually yield for a client on his portfolio. This question is, I have about 90% of my funds in equity. The client is around 46 years old. Should he start debt in funds now?
So the first things, I think it's again must compliment that the aggression on equity. I presume when you say 90% in equity, you are assessing 90% across your entire net worth. Like I said at the beginning, many a time when people tell me about the asset allocation, it is asset allocation limited to their investments they have done. So if they have invested 25 lakhs through Standard Chartered, they think 90% of that is their total. I would ask you to just go back and assess what is the amount in equity, what is the amount you have in real estate, do you have any insurance, FDs, your PF and all of that. And then if it's 90% at the age of 46, I would seriously start cutting back to around 60%. Now again, the level of equity depends on your income stream. If 90% and the balance 10% of your net worth is more than enough to meet your expenses, 90% can be okay. But I think 90% generally as a thumb rule is fairly high for a person who is at 46. So if I'm 48, I would currently have 55 to 60 in equity and the balance 40 across real estate, fixed income and all that. So when I say 60, it is 60% of my net worth which is in equity. It is not 60% of my disposable investment which is in equity. And that's where people either overestimate or underestimate their asset allocation.
So this question, maybe I could take it. What is your opinion on investment in forex? Uh, Please bear in mind when you're investing in forex, a lot of it is not under control because whatever is our whether you're investing in a euro, USD, they all linked to the currency of that country, and this market is very diverse with big institutional players. So it's very tough for a retail or a smaller client to take exposure. Forex should be used only when if you're traveling abroad or you're leaving rather than doing an investment. I'm not sure, Gaurav, you want to add something?
No, I presume, I don't know if the question is should I invest overseas or not, or is it just buying forex? If it is forex, I completely go with your point. Forex is just for when you're traveling or you have a need for paying off a liability in foreign currency. However, if you're looking and asking the question, should I also start looking at investing overseas? There, I think I would tend to agree that yes, it's at some stage you need to look at investing overseas, especially with most of our kids now wanting to do their education abroad. Most of us have a foreign liability which is likely to come up over the next 5, 10, 15 years, and hence to create an asset for that foreign liability, it's not a bad idea to look at investing in offshore funds. And again, I think your relationship managers, advisors can give you a fair bouquet of funds available in India, which enables you to invest in US markets, European markets, and all of that. So if that's the question, yes. But if it's only forex, I think I would go with Vinay.
Yeah, actually, if the question is on offshore investments, then there's mutual funds have its own funds which are feeder funds which also invest in different markets, and it's good to have a bit of world equities exposure because in case of volatile times, especially developed markets tend to outperform because they don't rise that much, so the fall is also muted compared to what you would see in emerging market like India. This question is how can we position PMS in a how do we position PMS in asset management?
Again, I might be biased in saying this. I've never found a significant difference in returns between a PMS and a mutual fund. On the contrary, I think PMS, given the nature of its taxation, is far more tax onerous on an individual than a mutual fund. So, like I said, I've always tended to keep my investments very simple and to an extent even boring. Until I see significant alpha coming from PMS, which I think the team at Standard Chartered might be able to help. For a client whose net worth is less than 10 crores, I don't think PMS should be considered till that stage. Post that, from a diversification, if it's a thematic play, concentrated bet, PMS, worth looking at. But again, the question to ask is how much can you invest? That again depends on your risk profile. So I've not been a big fan of PMS. Not that we don't offer PMS as IDFC AMC, but I think it's for a very, very boutique segment and a differentiated set of clients, as against most of us who are salaried and and trying to create a decent size of wealth.
So these questions are from young professionals. So one mainly from the IT sector also. One is how to start the journey of investments. Where shall I gather knowledge on investments? And second is since they are starting off, they would have basically their earnings are minimal to start with. So should I go about my?
So I think in terms of knowledge, I think there are more than enough sites available where you can get knowledge. The best site I think you should go is the mutualfundsahiye.com. There's a wealth of information on not only mutual funds but on financial planning. I bet Standard Chartered Bank also has links to various learning sites. So from a learning knowledge perspective, there is no dearth of websites you can go and visit. How do you start your investment journey? Like I said, it's a very simple 3-step process. Determine what is your financial goal, which is what is point A and what is point B. Basis your current risk profile, which you can assess with your relationship manager. Determine the asset allocation, and 3, just keep monitoring it. It's as simple as that. Many a time people think that investing is far more tactical, far more opportunistic, but rest assured, if you just do these 3 simple steps, you will create wealth over the long run.
So there are few questions where specifically on intraday trading. Should I do intraday trading? And I saw guessing with the profile of the client, I would avoid that you do intraday trading. Intraday trading also needs a lot of technical know-how as well as of fundamental knowledge. The best part of investing in a mutual fund or in a diversified fund is that you get a whole bouquet of this thing and you diversify your risk. The reward might not be good, but in case of intraday also you can have very significant risk. And most of the intraday trading is done on leverage. And as Gaurav said, leverage, never do investments at leverage. First clear your leverage and then do investments, so that in your long term you can create a lot of good wealth. So we are quite close to the closing time, so we'll take just last few questions. Maybe Gaurav, on just if you want to give some final comments on how to plan your investment journey to our clients.
Okay, so let me quickly summarize what I said in the beginning, and right through the question answers I've stated. So the planning of investment journey starts from the simple basics as to what are you saving for, and trust you me, it's a very, very difficult ask. So if everyone on the call can have one takeaway, is that at the end of the call over the weekend, take a blank piece of paper and literally write down what are you planning to save for. And trust you me, it's a very, very tough job. So I've asked a lot of my colleagues, my advisors and all that, have you done that exercise? And many a time people get very, very flummoxed and challenged by that exercise. It's as simple as like we do a laundry list or shopping list. It's what am I saving for? Am I saving for? And over a period of time we'll figure out. And again, don't get too academic in saying I only need to save for my retirement or my child's education or building a house. Those are mandatory savings. But if you are a travel enthusiast, please put in that I like to travel every year to a destination which costs me 5 lakhs, and hence that is a must do in my savings list. I want to change my phone every 2 years, put that down, because many a time people move between extremes. So if someone has knowledge of savings, they only look at the financial goals, which appears very boring, which is saving for your child's education, marriage and all of that. But many a time they leave the fact that there are enough and more things we also aspire and do, like travel. I for example, love traveling. So every year I know I have to have a budget of X amount of rupees for my travel. So when I put that down on a piece of paper, automatically, and that's 90% of your job done. Once you do that, the remaining pieces of asset allocation fit it very seamlessly. And trust you me, it's a very, very simple exercise. Do spend time with your advisor, your relationship manager or counselor. And I keep repeating this, and people say, oh, do they add value? They add significant value in that many a time we tend to drift, and that's where they pull you back, because they are an independent voice who's looking at you in terms of not only the individual but in your cash flows, because they know what your cash flows are, and just trying to rein in what I call excesses. Many a time we tend to drift and do excesses. They will just bring you back. Now final choice is yours, but many a time if you have to go by their advice, you would be clearly on the path to creating wealth over the long run.
Thank you so much, Gaurav, for joining us. Thank you, clients. We hope that this webinar was useful. As I can see in the question answer list, there's a lot of questions which have not got answered. Thank you for your active participation. In case you still have certain questions, please reach out to your RM and your investment advisor. We'll be very happy to answer this question. At the end of this webinar, there will be a survey form which would be sent to you all. Please respond, give any feedback you all have, any changes you want to do. These webinars have been going on for quite some time, so we would look for your active feedback, and hope this webinar will help you in your investment journey. And please reach out to us. We'll be glad to help you all. Thank you all for joining in, and have a good day.
Thanks, and thanks for having me here.